All right, let me start with something that's probably going to feel a little uncomfortable. You know that person, the market genius, the one who always seems to know what's about to happen. They called the crypto run before it happened. They sold tech before it crashed. They're always early, always confident, always posting screenshots. And then there's you. You just auto invest every month. Same index fund, same day. No predictions, no dramatic moves, no hot takes. Just boring. And sometimes, especially when markets are going crazy, you wonder, am I too average for this? Do I need to be smarter? Do I need to understand macroeconomics, bond yields, the Fed, earnings reports, AI trends, and whatever CNBC is yelling about today? Because it feels like the people who win at investing are the ones who are brilliant, the ones with talent, the ones who see things. Okay, here's the thing. Over 30 years, talent almost never beats consistency. And, not by a little, by a humiliating amount. My name is Jimmy, and I spend way too much time thinking about money, investing, and why smart people sabotage themselves financially. If you're someone who's trying to build wealth, but constantly feels like you're not smart enough to win in the market, hit subscribe and give this video a thumbs up. Because today we're going to compare two investors over 30 years. One is a genius, the other is boring. And by the end of this, you're going to realize something that might completely change how you approach investing. Let's meet them. Investor number one, Daniel. Daniel is gifted. He reads 10K reports for fun. He understands valuation models. He follows global macro trends. He times entries. He times exits. He rotates sectors. He prides himself on being rational. Daniel believes talent wins. Investor number two, Sarah. Sarah is aggressively average. She doesn't read earnings reports. She doesn't time the market. She doesn't rotate sectors. She invests $500 every single month into a low-cost S&P 500 index fund. That's it. No drama. Just autopilot. Now look, if we're being honest, most people assume Daniel wins, because talent wins in almost everything else. The smartest lawyer wins. The best athlete wins. The most gifted musician wins. So surely the most talented investor wins. Right? Here's what most people don't realize. Investing is not a performance competition. It's a behavior competition. And behavior compounds. Let's run the math. Over the last 30 years, the S&P 500 has returned roughly 10% annually on average, according to long-term data from S&P Global and historical performance studies. Not every year. Some years were disasters, some years were incredible. But over decades, about 10%. So Sarah invests $500 per month for 30 years at a 10% annual return. That's $6,000 per year. Over 30 years, she contributes $180,000. At 10% compounded annually, she ends up with roughly $1.13 million. No stock picking, no predictions, no talent, just math. Now let's look at Daniel. Daniel doesn't just match the market, he outperforms. Let's say he's legitimately talented. He averages 12% per year instead of 10%. That's impressive. Over 30 years, that 2% difference is massive. If Daniel also invests $500 per month at 12%, he ends up with about $1.75 million. He crushes Sarah. Game over. Except, that's not the real comparison. Because here's where it gets interesting. The question isn't whether talent can outperform. It's whether talent survives long enough to compound. Now you might be thinking, okay, Jimmy, if someone earns 12% instead of 10%, obviously they win. Yes, if they actually earn 12% consistently for 30 years. But here's the uncomfortable statistic. According to Dalbar's quantitative analysis of investor behavior, the average equity fund investor significantly underperforms the market. Over 20-year periods, while the S&P might return around 9 to 10%, the average investor earns closer to 6%. Why? Not because they're unintelligent, because they react. They chase performance. They panic sell. They rotate into what just went up. They exit after downturns. Talent doesn't protect you from emotion. Sometimes it makes it worse, because smart people trust their instincts more. Daniel's biggest risk isn't being wrong, it's believing he can't be. Let's make this more realistic. Instead of earning 12% consistently, Daniel has cycles. He has a few incredible years. He times a tech boom. He catches a breakout. He outperforms by 20% in 1 year. His confidence skyrockets. Then a downturn hits. He rotates out. He waits for confirmation. He re-enters late. He misses the rebound. Over time, his actual return averages 8%. Still good, still above average, but below the index. And here's the silent killer. He pauses investing during uncertain times. Just for a year, maybe 2. He wants clarity. He wants confirmation. He wants to be smart. Meanwhile, Sarah, she never pauses. She invests during crashes. She invests during bubbles. She invests when headlines scream. She invests when nobody's paying attention because she doesn't rely on feelings. She relies on a calendar. Now, let's rerun the math. Sarah, $500 per month, 10% annual return, 30 years, approximately $1.13 million. Daniel, $500 per month, 8% annual return, misses 2 full years of contributions, approximately roughly $820,000. The genius ends up with $300,000 less than the boring investor. And here's what most people don't realize. The difference isn't intelligence, it's consistency during discomfort. This is where psychology crushes talent. Investing is one of the only arenas where doing less often produces more. Imagine 2 farmers. One checks the soil every day, second guesses the weather, replants seeds constantly because he thinks he can optimize yield. The other plants on schedule, waters on schedule, waits. Over 30 years, who wins? The one who stayed. Here's another uncomfortable truth. The market rewards time in the market more than timing the market. Fidelity once studied millions of accounts and found that some of the best performing accounts belonged to people who forgot they had accounts. Or were dead. That's not a joke, because they didn't touch anything. No emotion, no interference, no talent required. Now you might be thinking, okay, but I want to be above average. Good. You should. But here's the twist. Consistency is a skill, and it's rarer than intelligence. Anyone can learn financial models. Very few people can tolerate boredom. Compound interest is violent, eventually. But for the first 10 years, it's painfully unimpressive. Let's break that down. At 10%, if you invest $6,000 per year, after 5 years, you have about $38,000. After 10 years, about $96,000. After 15 years, around $190,000. It feels slow. But between years 20 and 30, that's when the machine wakes up. Years 20, around $380,000. Year 25, around $650,000. Year 30, $1.13 million. The last 10 years contribute more growth than the first 20. That's not talent, that's time. And here's where it gets psychological. Most people quit before the curve bends. They assume it's not working. They assume they need to be smarter. They assume someone else has secret knowledge. But what they actually need is endurance. Talent seeks stimulation. Consistency tolerates monotony. And markets reward monotony. Let's go deeper. There's something called overconfidence bias. Studies in behavioral finance consistently show that investors who trade more earn less. Barber and Odeon's famous study found that the most active traders underperformed the market by significant margins. Why? Because every trade feels like progress. But activity isn't productivity. In investing, action often subtracts value. Daniel makes 20 decisions per year. Sarah makes 1. Who has more chances to be wrong? Who has more opportunities to let ego interfere? Here's what most people don't realize. Investing isn't about being right often. It's about being wrong rarely in catastrophic ways. Consistency avoids catastrophe. Talent sometimes invites it. One bad concentrated bet. One over-leveraged move. One, I'm sure about this. 30 years is long enough for ego to get punished. And here's something even more interesting. Consistency reduces decision fatigue. If you automate your investing, no monthly debate, no timing stress, no headline analysis, no emotional energy drain. You free up cognitive bandwidth. That matters, because wealth building isn't just math, it's sustainability. If your strategy requires constant brilliance, you will burn out. If it requires showing up once per month automatically, you can do that for decades. Now you might be thinking, are you saying skill doesn't matter? No, skill matters, but only after behavior is mastered.